Michael Purves is the Weeden Company Chief Global Strategist. Are you concerned about this flattening yield curve?
Not right now, no. I think we've talked about this in the past, but the yield curve has been
ad nauseum. It's
ad nauseum. But look, the long end of the curve is really a global phenomenon, and we have 10-year bonds at 40 basis points, and their counterparts in Japan close to zero, and that's clearly been a key driver of that.
Right.
The bond market's more globalized today than it was during the past several hiking periods, going back to 1970.
Yeah.
So as the U.S. economy continues to perform, you should expect a flattening of the yield curve.
Right.
What flows into this discussion is the fact that the inflation, just like bond yields are global, so are the inflation expectations. If you look at 10-year forwards, it's amazingly how synchronized those are across Germany, Japan, and the United States there as well. And so that gets to some part of this cause. When you talk about the inflation discussion, you really have to talk about it from a sort of a global perspective.
You do. It has to be relative, absolutely. And speaking of relativity, we're going to be watching Bank of Korea and what they're going to do on interest rates later today. But Michael, getting back on the Fed itself, though, what do you think you learned between Powell and Yellen? Well,
effectively, they're the same on monetary policy. But Powell is really a Republican, if you will, on regulation. It's from a market point of view, it's actually the most market-friendly outcome you could possibly get, right? Because you basically have a new version of Yellen, except he's clearly helped the bank stocks this week with his nudge forwards on less regulation, and I think that's about as market-friendly situation as you could probably find.
Well, of course, he does say he's going to keep core reforms in place. Higher bank capital is not going away. Bank stress tests are not going away. He does want to right-size some of these regulations. I want to come back to the yield curve, though, because to me a very important question is this: the reason that long-term yields have fallen. Sure, there's global forces, but it seems to me if you are looking at inflation now, seeing an economy that may be downshifting to the 2.5%, and the Fed keeps hiking rates, if I'm a person who buys bonds and even longer duration, I might say, hey, this is great. There's low inflation. The Fed's tightening. What a great scenario for bonds, because this is not a stimulative impulse. This is contractionary. And it seeps to me that that's another message from this yield curve, potentially, Michael.
That's a very fair point. I think like we were just talking about, the distortions in the yield curve are very, very substantial. And of course, part of those distortions are because some of these disinflationary forces are things that we've never had before, right? How fixed assets like buildings are becoming much more efficient, Airbnb being an example of that, cars with Uber, globalization, technology. I mean, the pace of the technological acceleration has been so dramatic there. And so I think there is a case where you could, if inflation may be lower longer for quite some period of time, and the economic engine may be pretty strong there. I think it's as you sort of connect that back into equity markets, I think you have to be very, that really, where inflation goes is really going to be, to my mind, really defined more than anything else where price earnings multiples on the S&P 500 go, for that matter. There, inflation is really the wild card, and so far it's been the most confusing thing for the Fed, or for that matter any central bank or any of us to really try to figure out.
Michael, I'm just going to jump in with some breaking news. It's just crossing the Bloomberg. But Australia's Prime Minister Malcolm Turnbull calling for a 12-month Royal Commission, reporting date Royal Commission into the Australian banking industry. This, of course, coming after months of opposition requests for an inquiry into the sector. Also saying that the Royal Commission will not put capitalism on trial, calling for this inquiry into the financial industry. Also saying, Malcolm Turnbull, that we need to stop using banks as a political football, and that the speculation about this banking inquiry cannot go on, and that the uncertainty over whether or not we're going to get a Royal Commission into Australian banks is weighing on the economy. He's addressing the media in Canberra. Interestingly, this actually comes on the back of the CEOs of the big four banks all coming together and calling on the government to establish an inquiry to break this kind of will they, won't they, saying that this political uncertainty is weighing on the banking sector. And, you know, of course, we know this comes along the backdrop of lots of banks behaving badly type negative headlines, accusations of rate rigging, you know, poor advice given to consumers, misleading advice, and breaches of anti-money laundering laws. So we're just getting some more details on that, but it does look like this Royal Commission into Australian banks may be happening now. Michael, you know, I want to actually go back to what we're talking about as to what kind of Fed Chair Jay Powell is going to be. Do you think regulation or deregulation is really the area where he's going to make his own mark and not just be seen as, you know, a Yellen 2.0?
I would say there's two areas that I'm hopeful he might focus on. The first is some at least marginal increase in lower, less bank regulation. I think the other thing is that, you know, he is a Wall Streeter. He worked at Carlyle and I believe Dillon Reed as well early in his career. And while I'm sure he understands the economics extremely well, he's not a PhD. But I think this combination of having, you know, a lot of fluency with economics, but also having, you know, lived on trading, seen a trading floor and worked in that environment is really helpful, because I think one of the factors with all of this extreme gradualism we're seeing from BOJ, ECB, and the Fed is that, you know, we're seeing this sort of stifling of volatility. And what we don't know is that as the central banks, you know, presumably continue to retrench from their balance sheets, whether there'll be things like liquidity black holes. And I think that's a huge story going into 18 and 19 is when things go bump in the night with central banks not there providing liquidity. Are there real trading issues? Because market structure has been transformed very substantially.
Quick question. We had a story today on the Bloomberg. 4 CEOs on their earnings calls saying, hey, yeah, we're looking forward to tax cuts because we're going to do more share buybacks.
Right.
We're going to pass this on to our shareholders.
Right.
This seems to go totally flying in the face of those who would argue on the Republican side, boost wages, more jobs, et cetera. Janet Yellen kind of commented on this today, too. Doesn't seem like it's going to help wages, workers, or the economy. How do you look at it from an equity standpoint? Well,
you know, frankly, it's something I would have expected a Coca-Cola or any other global company to actually do. I was surprised to hear them say it so bluntly. I don't see how they're served by that. But I think it's sort of inevitable. In this country, you can't mandate a company to hire people, right, or to spend money on new factories and so forth. So I think it's sort of inevitable that they will expand when they see it, when they think it's right for them to expand, and not until then.
Well, I want to throw up this quick chart, which, you know, I don't know whether it's more telling in the sense that I don't know if you can use fundamentals to really judge something like Bitcoin, right? It's suggesting that it's been, what, about 2 years since it signaled oversold. It's now with an RSI of about 75, firmly overbought. But this kind of goes to the core of the question, right? Do we judge this like we would a conventional asset class? You know, what is it? Is it a currency? Is it a commodity? Is it a bubble? What do you think about this whole thing?
Well, at first, just on your chart, I would make this point, which is that if you're going to go invest in Bitcoin or trade Bitcoin, it is 100% and nothing other than a pure technical analysis. So if you're going to be doing this, you have to assume that you're a better technician than the next person. You know, we can have a long-ranging discussion about what Bitcoin means and all that kind of stuff, but there really are. I don't think there's any fundamental framework by which you can understand whether Bitcoin should be at 10,000 or 100,000 or $100. It's all technical. I think if you're buying this stuff right now, or with the hope of selling it at a profit down the road, it's purely technical. I don't know how else. Gold is hard enough to value, but at least you can come up with some arguments here. Right. You can come up with various analyses, and that still becomes one of the most technical trades you can possibly do.
It is, I would say, very similar to gold, right? If you think about Bitcoin.
Well, sure. It's the newest currency in the world against the oldest currency in the world.
Right, exactly.
And there are a lot of similarities.
But here's my question. So, I mean, what is it like now? The market cap is, what, $100 billion of Bitcoin, which is, I think they said, you know, it's a little bit over what Netflix is worth, right? I mean, it's a drop in the bucket. Why are we so obsessed with Bitcoin?
Because it's one of the few charts, you know, to that chart earlier, it's one of those few charts that's actually interesting to watch.
But who cares if it's in a bubble? It's not going to affect anything, right?
No, I mean, some people will lose a lot of money, some people will make a lot of money. Right. It's as simple as that.
So we're just obsessed with it because of its stellar rise.
Well, it's a fascinating chart to watch. And I think also, if you stand back for a second and you think about currencies broadly. A few years, not more than a decade and a half ago, you had the euro created, right? And that was a really pretty monumental event. And I'm sure in the back of a lot of people's minds, there was this concept one day we'll have like the world O, if you will, right? A euro
right.
for the globe, right? And Bitcoin, in a way, had sort of filled that role to a certain degree. So I think in one concept, but I at the same time, I think probably every serious central bank out there is really trying to get their arms around that.
But do you think that's why you've got so many people like Bogle or Stiglitz or some really big, big icons in the financial world coming out against it? Do you think there's some fear factor here?
Well, I mean, a fear of what exactly, right? I mean, if you have a fear of fiat currencies collapsing, you can buy gold, and people have been doing that for centuries. I would say that it's certainly a fear of, oh my God, does this make drug dealing and illegal behavior a lot more easy there? And I'm sure it does. I still question that all these digital trails have a trail someplace, right? So I do have questions about that. But I think it's just because it sort of dominates every cocktail party conversation. You can't get in a taxi in New York without having a conversation about Bitcoin, it seems like these days. So it's on everyone's mind. But Betty, I think you make a good point, which is that if it went to zero tomorrow,
who cares?
Does it really matter? And I suspect, no, it doesn't. But I do think, and this putting Bitcoin, the blockchain aside for the moment, I do think that this concept of having some sort of digital currency as an alternative with which to conduct transactions, and that's not a fiat currency per se, that has some kind of really resonates, just like gold did back in 2010 when QE was getting going and everyone thought the dollar was going to collapse and all that. So, but meanwhile,
is a regulatory pushback.
I'm sorry?
You say central banks and policymakers are kind of struggling to get their heads around this and how to regulate around it. Is that kind of the biggest downside risk, do you think? Or do you think, conversely, if the institutional take-up is going to be slow, then, a number of these conventional institutions are actually doing a disservice to their clients?
Look, I think, when you talk about the central banks wanting to, potentially figuring out creating their own digital currencies there that would be, sort of with this, a United States stamp of approval or some other nation stamp of approval. I think there's an understanding there that if there's attractive features of having a digital currency, that there's a lot to be said for knowing exactly how much is out there. I don't think, there's no M1 or M2 for Bitcoin, right? There's a lot of lost Bitcoins, and we don't know how many are lost and whether they really are lost, right? So I think, or for that matter, how many more can be mined, right? It's very unclear. And I think the attractiveness of digital currencies may, down the road, not tomorrow, but in a few years, perhaps be replicated by central banks.
Michael, we've literally only got a few seconds. I want to ask you quickly about tax reform. Does it matter whether it passes or not by the end of this year to the markets? To
the overall market, I look at it as a free call option. If it doesn't pass, I think the markets are going to keep grinding higher. Just you have to be in the right sectors. If it does pass, then obviously small caps and some of the high-paying stocks will be outperformers.